What's going on, everyone? My name is D. Anthony with Evolution Traders. In this video, we're going to talk about how you can lose less trades, how you can lose less money, because ultimately, isn't that what we're all trying to do? We're all trying to make more money as a trader, and we're trying to lose less. Sounds easier said than done, but there's a couple of things that you guys need to be aware of when it comes to trading. It doesn't matter if you're trading the NASDAQ or you're trading the ES or you're trading options or you're trading crypto or Forex. It doesn't matter what you're trading. But what you need to kind of focus on is technical analysis, having a good understanding of price action, and understanding the day's trend. Okay, so depending on the time frame that you trade, in this particular example, we're going to be looking at the 5-minute time frame. I like to take a lot of my trades off the 5-minute time frame. I use the 5-minute time frame for a gauge. I use it for a stop loss. I use it for scalps. I use the 5-minute time frame a lot. I also use the 1 hour, and I also use the daily for kind of my overall macro market sentiment. So if we were looking at this chart, right, we're going to go back, look in hindsight, and we're going to look at this chart. Would you say that the chart is long biased or is it short biased? Okay, so I want you to really take a look at the chart. Notice the red candles, notice the green candles. Disregard everything else that's on my chart, all of the other moving averages, all of the other supply and demand zones. Just disregard all of that stuff. And I'm actually going to make it a little bit more clear to you. I'm going to take everything off the chart and I'm just going to use the 20 period moving average on the chart. Now, would you say, and I'll back this up and include a little bit of pre-market data here, would you say that the trend is going up or the trend is going down? Okay. Now, unless you need prescription lenses, or unless you can't really see the charts all that well due to a medical condition, you can see that the chart looks bullish. Okay, there's nothing really about this chart on a 5-minute time frame stemming all the way from the pre-market that looks bearish. So why is it that a lot of traders tend to want to short the market when the market looks bullish? What about you is telling you that the market can't go higher? You know, some of the answers that I've heard in the past is, the RSI is overbought, or, the market was pushing higher from the previous day and it's overextended. We're oversold, when the market is down. What about this chart though? Just looking at it, looks like it's a sell-sided chart. We can see from down here in the pre-market action that we've got a visible low of day on the NASDAQ sitting down here at 16,255. So if price action was to break 16,255, would you say that the price action is bullish or bearish? I would think that majority of you out there would say bearish, right? Because if we're going to lose a previous level that we were trading at in the after hours, in the pre-market, right off the market open, and now we were trading above it and now we're trading below it, the price action has kind of shifted. The sentiment has kind of shifted from long-sided to short-sided. So what I want you guys to do, and what's going to really help you make more money and lose less trades and ultimately lose less money, is to stay on the right side of the trend. Now, of course, it's very easy to see the trend once the price action is already passed, right? So it's easy to look at this chart right now and say that you should have been long biased. Okay. So if we kind of remove everything off this chart and we just look at the market open, and I'm just going to kind of pull this up off the market open, right? I'm going to pull this price action up off the market open. So this price action that we're looking at here, and I'll actually scroll a little bit this way so we can see it a little bit better. But if we disregard everything that's going on here, this is the market open. This is going into 2 hours of after the market open. Looking at the first 2 hours of work, would you say that this price action is bullish or bearish? The price action is clearly bullish because we're making higher highs, right? It's not until we break down below a 20 period moving average where there's potentially a market shift where you can potentially catch some money. However, if you want to lose less trades, instead of looking for these type of scalps, right? Instead of looking for these type of scalps when the market is uptrending, so you notice this close below the 20-period moving average, you notice how it gives you a little bit of a move. This wasn't a clear one-to-one trade, and I know that for a fact because me and one of the members in Evolution Traders back tested this today. This was a 30-point stop loss for a 30-point pickup, actually 29 points, and it actually touched it to a T and then reversed. But if you're looking to lose less money and you're looking to lose less trades, why would you want to put yourself in this particular situation where you're going against a trend, especially if we're above, you know, the overnight session lows, right? And especially if we're barely losing the 20 SMA and we're still above the opening range 5-minute candle or the opening range 1-hour candle. Why would you want to go against a trend versus sitting back and waiting for something like this to appear, which is a reconfirmation of the 20-period moving average that some of the members in Evolution Traders took today? And even though we only took, you know, a 1-hour trade on this particular move, which is about 15 points, almost closer to 20 points here, it ran up a lot higher. There was multiple setups that you could have taken today on the long side. So if I just kind of break this price action down, and I want to break something down to you guys very clearly, look at the 5-minute candle that happened right before the market opened. It was a 20 play over the 20 SMA. Even if you would have used the reason why candle as a 1-bar stop, it comes down to that level, never breaches it, never closes below it, you would have potentially caught a 50 to 60 point move higher. Okay, let's move to the next trade. Let's say, for example, you wanted to take a long position over the pre-market highs. Well, notice how we break the highs at 16,310 and we run all the way up to a price of 16,350. This was a 40-point move higher. You could have used your entry candle's low or previous 5-minute candle low as a stop. Yes, would your stop loss be a decent size? Would you have taken a decent size lick on it if you would have lost? Of course. But how do you manage bigger risk, smaller contracts? So we're not going to play 5 contracts giving up 50 points. Maybe we play 3. Or if you normally play 3 contracts, maybe we play 1. We still want to be a part of the move, right? We still want to get to the party, but we don't want to get drunk is what I'm trying to say, right? So we can definitely show up to the party. We can have 1 or 2 drinks. We can have a few drinks. We can have a handful of drinks. We can have ourselves a good time. We can laugh. We can talk. We can dance. But I don't want to take 10 shots when I walk in to the party and be passed out 30 minutes later. Does that reference kind of make sense, right? So if you think about it, if you think about that analogy, I don't want to give up 40 or 50 or 60 points even by taking 10 contracts, right? Let's use that. I don't want to drink 10 drinks when I walk into the party, but I still want to enjoy myself and I want to be involved in the party. So maybe I'll take 1 contract or I'll take 2. So even if I lose 40 or 50 points, I'm only going to lose, you know, $100 or whatever, however many contracts you're taking, but you're still involved in the movement and you're still involved in the party. Okay, so let's just keep this story going. Let's keep the narrative going. What would be the next potential play? The next potential play would be a break over the 1st-hour highs. So if you look at where the 1st-hour highs are at, the 1st-hour highs are here. Now, this particular situation gets a little bit more tricky because it does confirm the 1st-hour highs and then pulls back. So what's going to be your stop loss? Your stop loss has to be one of 2 places, okay? One of 2 places. That's going to be below a prior swing low, which is here. And on this particular play, you're giving up around 30 points, or it needs to be a close below the 20 SMA. Does that make sense? Why does it need to be a close below the 20 SMA? Because that would be indicating a short-term change in trend. Now you no longer want to be long. You either want to be on the sidelines or you want to be involved in a short position. So depending on the level of risk that you want to take, you can take a stop loss below the previous swing lows. So notice if we're looking for a breakout over the 1st-hour highs, which is here, okay, and I'll draw a line so we can see this. This is your entry, but notice how the next 5-minute candle starts to pull back. and you actually get into a drawdown for 25 minutes. Now, this particular situation, my friends, is where a lot of traders tend to stop themselves out, is where a lot of traders have a stop loss that's too tight, that gets triggered. And then if you notice, the stock continues to put in a new high, which you actually would have made money. Okay, so notice those type of things. Stay on the right side of the trend. Make sure that you're not going against the trend. Make sure that you're not playing the hoping game, and make sure that you have your stop losses set up into a way where there's technical damage being done, so you'll be able to identify those moves and get out of the trade. And if there's no technical damage being done, you can continue to sit in the trades until you make money or get stopped out. So if you want to lose less trades, look at the chart. Where are you trading at in the chart? What is the direction of the move? If the move is going higher, let's ignore the pullbacks, ignore the pullbacks, ignore the pullbacks, ignore the consolidation, and just look for the long plays. Just look for the long plays. Okay? Just look for the long plays. Just look for the long plays. Notice how if you stay with the trend, you're a lot safer, you lose a lot less trades, and you lose a lot less money. If you guys want to join Evolution Traders, where you guys can trade with me each and every single day live, that link is down in the description box below. I would love to see you guys in there before the new year. I will catch all of you guys on the next video.